Welcome back, fellow dividend investors. Today I would like to share with you some of my analysis about 5 industrial dividend stocks: Honeywell, 3M, Schneider Electric, ABB and Siemens. All of these have seen quite some price decline since the start of this year, and as you can imagine, this caught my attention and it made me actually curious if there's anything in there which I would like to buy right now. But what you do need to know is that industrials are very cyclical, and in my opinion, we are definitely not yet near the bottom of a cycle. But still, it neither means that there's no value out there. So let's get started and have a look into these 5 dividend stocks. So the first thing that caught my attention is that Schneider Electric has been so far the biggest loser of the cohort with 17.3%, slightly followed by 3M, which is a surprise because most of you know that 3M has currently quite some headwinds, and the biggest headwind comes from an earplug litigation. And this is looking really bad at the moment because 2 army veterans were awarded 110 million in a 3M earplug lawsuit. And there's no settlement here, so many more are expected to come. Actually, if we look at one of the analysts from Morgan Stanley, this person believes that there is a base case for a liability of a total of $14 billion. Best case scenario of $2 billion and a worst case of $53 billion. This is not Mickey Mouse money, I can tell you that. So from that point of view, it's of course very interesting that 3M is actually not the biggest loser so far this year. But if we take the time horizon a little bit longer, what we can see here is that 3M is actually the biggest loser so far, with 16% over the full last year. But what we can also see is that Honeywell has been a big loser because it has been dropping already 10%. And the European companies have been so far doing much better with ABB 18% up. If we take it even longer, over a 5-year period, then we can see that Schneider Electric has been by far the best performer over this time period with 126% price increase. And 3M, once again, is a 21% loss over the last 5 years. So effectively it was dead money, and even worse, you lost on it if you look at it from a price appreciation point of view. But of course, most of this has to do with the earplug litigation because look, back in September it was still trading around $200, and since then they lost $50, 25%. So this is just something you need to know about it. It has a lot of headwinds. But okay, enough about share price talk. You know, I'm more interested in the value underneath it and the dividends. And let's do a small warm-up exercise. What I would like you to guess is actually, based on these 5 companies, this cohort, which has the largest market cap. It will surprise you, I think. It definitely did with me. So, first of all, the 5th company in market size is ABB with 68 billion. The 4th one, 75 billion, is 3M. I actually thought that this should have been the biggest, but no, it isn't. The 3rd one is Schneider Electric. The 2nd one is Honeywell, and tada, surprise, Siemens is by far the biggest industrial out of this cohort of 5 companies. This was really a surprise for me. I definitely thought that 3M would be on the top here. But let's do another trivia here. What are the best companies by operating margin? So if we look at the operating margin, Honeywell was just 2nd in size, has the lowest operating margin with 32%. Followed by ABB with 33% and then Siemens with 37%. So here, it doesn't matter so much if you're the biggest or the smallest. Operating margins are really due to their core products that they have and the efficiency and the effectiveness of the organization. Schneider Electric, a really strong operating margin with 41%, and 3M is the best well-run company out of this cohort with an operating margin of 47%. So a little bit of mind fucking here if you think about this. I wasn't aware of this, and I really like to look at it from such a point of view when we are comparing similar companies in a similar industry. Of course, these businesses are slightly different from each other with different product portfolios, different industries that they target as well. For instance, 3M is in healthcare, others might not be. But still, I think a 47% operating margin is really, really good from a company like 3M and stands really out from the cohort. Okay, enough about this trivia, let's do some number crunching. What I will show you now is a little bit line item by line item. I will show you how the companies compare to each other. I will highlight the best one with a green cell and the worst one with a red cell. It doesn't mean necessarily that it's a full judgment of a company, but it's more like here to trigger your thinking. So if we think about it from a revenue point of view, Siemens is by far the biggest. We saw that already in the market cap, so it should come as no surprise. It earns almost twice as much than Honeywell, the 2nd one in market cap. If we then look at it from a gross margin point of view, we spoke about it already, the largest one and Honeywell the lowest one. But if we look at a 5-year compounded annual growth rate of revenue, it's a bit hard and then probably a bit unfair to say, because there are some companies that are spinning off, there are companies that are organically growing or actually doing acquisitions. Based on these numbers, Siemens look good, but you need to know I had to calculate they were 3 years because of the spin-off of Siemens Energy. And ABB is the worst of the cohort from that point of view. But revenue growth here is really misleading, so it doesn't really tell me anything, and probably we should just ignore it. But if we look from a PE point of view, what we can say here is that ABB, with a PE of 14, is at the moment the cheapest of the cohort. 3M is actually closely followed by that, but the most expensive here is Schneider Electric with a current PE of 25. If we look at it from a cash flow point of view, you will see that it changes a little bit. Although Schneider is still the most expensive, suddenly Siemens is the cheapest. Now what's happening here? One-offs both in ABB and in Siemens. Generally, I would really like to call out that 3M has historically a really low multiple at the moment of 14 to 15. If we then look at the guidance going forward, you can see that all the companies are of course guiding forward an increasing earnings per share. Of course, you never hear them saying downgrade already, they are all optimistic still. But what it means from a PE going forward, again, that ABB is still the lowest, but still slightly tracked by 3M. Again, Schneider Electric just feels expensive if you look at the multiples. So now that we know the multiples, let's also look a little bit into the dividends, because that's of course what we are all investors for as dividend growth investors. Now what is really interesting here is that 3M is by far the largest dividend grower if it comes in terms of year. 64 consecutive years of dividend growth. This is really, really amazing, and rightly so, it is a dividend king. If we look at Honeywell, it is currently 12 years. I was expecting more. But what is really interesting to see here is that Honeywell only froze their dividend. Other than that, you can go back to the early 2000s and was freezing their dividend as well. But honestly, I take such a chart anytime. I really love these kind of charts, and I don't blame the company for freezing the dividend just after the Great Recession, like one of the biggest financial shocks that we've ever seen in the stock market. Now, if we then go to the dividend growth from the others, like Schneider Electric, ABB 12 years, 15 years, and Siemens 1 year, what you need to know is that Siemens cut the dividend because it was in 2020 €3.50 compared to €3.90 a year earlier. This has all to do with the spin-off of Siemens Energy. I don't know exactly how much Siemens Energy was part of the company, but what I do remember is that the dividend cut nicely aligns with the size of the Siemens Energy spin-off. So hence, it should also not come as a surprise that currently the dividend is then €4 again. I guess they are making up a little bit also for 2019. If we then look at ABB, what I also want you to know is that their dividend is really going nowhere over the last years. Look, 80 cents, 80 cents, 80 cents, and they just upgraded their dividend with the latest announcements to 82 cents per share. So if we then look at it from a dividend yield point of view, I believe that 3M is very attractive right now with a 4% yield. Actually, the last time that we saw that, I can't even remember. And also, if we go to IO charts, credits to the makers of this one, you can see that only in 2% of the time we saw a higher yield than what 3M currently is trading at. I think this is very important to know, because this is a very unique situation, of course, due to the litigation. If you look at the dividend per share growth, also amazing here. 3M is truly a dividend king here. If we then look at Schneider Electric, it is currently a dividend of 2%, the lowest of the whole cohort. But also Honeywell, 2.15, it's also not too high. ABB, 2.6. You do know, like Swiss stocks, 35% dividend tax. There you go, up in the ass. So for me, that makes ABB already totally not attractive. But with Schneider Electric, it really seems to be just a value story, because it seems to be still too expensive, although the company lost already 16% in share price since the beginning of this year. Well, hey, these companies, some of these are also buying back shares. And from a buyback yield, you can see that Honeywell is really aggressively buying back shares compared to Siemens, which is almost doing nothing. At least not a lot worth mentioning. So together gives this, from a shareholder yield point of view, you can still see that 3M is by far the best one. It has been aggressively buying back shares over the last year. I actually don't know if this will be the same going forward, because going forward I couldn't see any information. I do know that Schneider Electric is going to buy back a lot of shares going forward. I do know ABB, but I don't know about 3M. So then the question is, of course, if we look at these numbers, a shareholder yield of 6.6% by 3M is really high. So is the dividend safe then? Now, one way of looking at the dividend safety for me is going to the payout ratios, because this tells us a little bit already. If we look at it from payout ratio, and at least from the EPS, we can see here, of course, the one-offs again. But what is probably good to see now that we are at this topic of 3M, it's for me still under 60%. And this is important for me. Stocks under 60 or 70% even, like a stable company like 3M, are for me already quite safe in consideration. Also knowing that their EPS guidance going forward is similar to what it was last year, I believe that the company is still in a healthy position from a dividend point of view, and I consider the dividend safe. And even more if we know that the company just hiked the dividend the other day with 1 cent. So the company knows that it's going through some shitty weather right now, and that's why it's probably really conservative. So the question for you now is this company then attractive to buy at a 4% yield, knowing that you might see 2-3 years of flat dividend while it's trying to get through its issue? And it's not only the litigation, it's also like organic growth where it's struggling a little bit. Is this worth it? I'll give you my opinion later a little bit, but it's, I think, good to take into consideration. But the true king here is Honeywell, that has been aggressively increasing their dividend with 8% annually. A little bit lower last year with 5.3%, but still really good. And as I mentioned already before, ABB is really the dog into this cohort. And in my opinion, it's just really not a nice dividend stock at this moment in time. It needs to change a lot. But there is one little dark horse there, and that's again Schneider Electric. Look at that, 7.3% 5-year dividend compounded annual growth rate and almost 12% in the last year. This again tells us that Schneider Electric is just overvalued right now. That's it. 3M is undervalued at the moment, I believe. If we look at the multiples, Schneider's overvalued. But it's really doing well, and probably rightly so at this price, because it's just the best of the cohort if you look at this together with Honeywell. Now let's also look a little bit from a dividend safety point of view at the balance sheets. What we can see here is that Schneider Electric again has the best balance sheet in my opinion, because their debt to equity is really low. However, there's one catch there that I want you to be aware of, and that is that Schneider Electric at the moment has 25 billion almost in goodwill on their balance sheet. That's about 40-45% of the total assets. So no surprise to me that Schneider Electric is a little bit conservative when it comes to their debt, because there's a lot of nothing behind it in goodwill. There's no assets behind it. It's what the idiot pays for it. On the other end, if you look then at 3M, it is having the worst balance sheet from here. Now, what I always find surprising, and this is probably to do with the fact that I'm not a credit analyst, on the other end, 3M and Siemens have the highest credit rating. So if you look at credit ratings here, A1, A2, and A3 are in the upper medium grade. All these 5 stocks are in there. So from an industrial point of view, they all have a sound balance sheet, and in my opinion, they will still exist 10 years from now. We shouldn't worry too much, neither in an economic down cycle, because they are protecting themselves for it. But it is interesting to see that the credit rating agencies are more bullish on the future prospect of 3M than, for instance, when I look at it myself. But of course, they also do analysis. They don't only look at the balance sheet, they also look at the future prospects. How's the company prepared? How's management executing? It's a whole bunch of parameters that led them to give a certain company a certain credit rating. So from my point of view, all these companies are safe. What I only would like to see is that 3M deleverages a little bit with their debt, and they have been doing that. They have been paying off their debt over the last few years, and it's therefore also going into the right direction. I will show you that soon. Now, last but not least, I also looked a little bit into the free cash flow of these companies, and what we can see that over the last year, ABB has been spending more from their free cash flow than they could afford, and this has definitely to do with the share buybacks that they were doing. Other than that, it looks actually quite solid, where, for instance, Siemens is really hoarding cash at the moment. Also here, it was deleveraging, which is really good to see. Now, what does this overview tell me? So if I look at these 5 companies and I would rank them by strength, not looking at the share price, number 1 for me is Schneider Electric. Number 2 for me is Honeywell. Number 3 for me is 3M. Number 4, Siemens. Number 5, ABB. The issue with Schneider Electric is it's just too expensive right now. It's currently trading at 144 euro. I believe for me, if I look at the multiples, let's say only, I would like to have it probably around 110 euro. I think it could get there. Of course, it depends a little bit on whether we get a stock market crash or not, but in such cases, consider me being a buyer around those. I won't go into full analysis. Secondly, I find 3M very attractive right now, and I might consider actually adding a little bit more to my portfolio. And the reason for that is just the uniqueness of a 4% yield. While I think the dividend is safe, if it doesn't grow for me for the next 2-3 years, I'm fine with that. Because if you look at the yields, other companies will need to grow for 5 to 10 years still to get to a similar yield as 3M today, if they will continue to grow the dividend as how they have been doing over the last 5 years. So from a 3M point of view, what I like here is that they are conservative when it comes to their free cash flow. They nicely do buybacks and share repurchases, and they didn't spend more than they had available in cash. At the same time, you can also see here that they've been paying down debt compared to last year. 2020 versus 2021 is almost $2 billion less. If we then go to my valuation here, I believe this company is currently valued of $142, and I'm quite conservative here. So I'm using for my baseline a cash flow of $5.5 billion. Last year's cash flow was $5.8 billion, so I'm a little bit more conservative here. I'm also taking conservative growth with 5 and 3% at a discount rate of 10%. Also, my terminal multiple is 14. I believe it's a good company. It's not outstanding like Microsoft or something like that. Hence, I believe that such a company warrants a 14 multiple. So from that point of view, $142, most of the key statistics are in green, and there's really nothing here that concerns me. But look, this one is not taking litigation into consideration. So why not calculate a little bit? What would it mean with litigation? So again here, my baseline case, similar here, but let's say the analyst is right, and it will be a 14 billion impact going forward. In that case, as you can see, the fair value of the company is, in my opinion, $115 or $116. This is a lot of difference, $25, and it would still mean that the company, by now, with the current share price, is still 22% overvalued. Now, what can I say? I see this scenario is actually quite likely. I don't mind buying a little bit now at a 4% yield, so probably I put a market order in this week. But consider me a large buyer when it hits $115, because I think then everything has been priced in and we're really talking about a value play. Until then, I believe that the 4% dividend yield here is actually kind of a cushion to the share price. If it really goes lower to 115, we're talking about really a safety net that got broken under the share price. Hey, it can happen, but again, I consider the dividend safe. So for me, 3M is really an attractive candidate. Well guys, this is it, my overview of industrials. If you haven't done so yet, please subscribe to the channel and like this video. It always puts a smile on my face to see your engagement. And if you're interested to learn more about Siemens, check the video on the left. And if you haven't seen my analysis about British American Tobacco yet, click the video on the right. For now, have a great week. See you around.